Now, when you got appointed, just a few days after you told a meeting of major banks and institutional investors that anyone who wanted the company to stay focused on short-term profits would be better putting their money elsewhere. Now, half that group is about short-term profits. Why did you put it in their faces?
Well, because it's proven to be true. You see the tenure of CEOs going down, the lifetime of publicly traded companies going down, the enormous value destruction in the US by just playing the short-term shareholder game, and by not investing in the companies, by not investing in your multiple stakeholders. Some of these companies find themselves short of talent, no resilience in their value chains, lack of innovation and innovation capabilities, and that music stopped playing after a while. So what we are basically saying is, be a company that profits from solving the world's problems, not creating the world's problems. And what we increasingly see, Jim, is that companies that actively already start to attack these negative externalities, work climate change issues, human rights issues, social safety nets for their workers, more gender balanced organizations, the racial dimension. Companies that work these things are increasingly also better valued by the financial market, which tells you that the financial market is smart. They've discovered that it's not just about risk mitigation, it's about an enormous opportunity. If COVID has done one thing to us, Jim, it has made us discover that we can't have healthy people on an unhealthy planet. And the cost that we have been paying for COVID has been enormous. $17 trillion in Europe and the US, $27 trillion less in GDP over this decade. People are starting to realize that the cost of inaction is higher than the cost of action. Right. And that is why the financial market is waking up.
Okay, so Paul, one last question. In the book, you talk about Salesforce doing right things, Apple doing right things. Are there a lot of companies doing right things that we should be looking at so we can get other models besides what you did at Unilever?
Oh, absolutely. And what you increasingly see is that within an industry, even if you compare companies within an industry, the ones that continue to deny that and charge these negative externalities to others in society are actually lower valued. Yes. You take the Exxons and the Chevrons versus the Orsteds or the Iberdrolas, you'll see the difference in market cap. And that is now true by every sector. Increasingly, we see companies thinking about regenerative agriculture, Walmart restoring 50 million acres of land and forest, protecting 1 million square miles of oceans, Microsoft taking carbon out of the air since 1975 when they started the company. Interface coming out with tiles that actually absorb carbon. Increasingly, we're seeing companies starting to think about net positive, but now we need to do that at scale and speed and do it holistically. And that's what the book is all about.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.